The accounting cycle. The first stage is to record accounting events in the journal and post it to the general ledger. The second step is to prepare the trial balance. The third step is to record adjusting journal entries, post to the ledger, and post the adjusted trial balance. The fourth step is to prepare financial statements. The fifth step is to record closing journal entries, post to the ledger, and prepare post-closing trial balance. The sixth and final step is to begin the new accounting period by returning back to the first step. Income includes both revenues and gains. They would cause an increase in economic benefits, therefore net assets would increase. This would result in a rise in equity cost other than owner's contribution. Revenues are another type of income. They are generated in the ordinary course of business. For example, core revenues tend to be something like sales or service revenue, while other revenues could include interest revenue, rent revenue, dividend revenue, commission revenue. These are calculated on a gross basis. Gains, on the other hand, may or may not be in the ordinary course of business. They are often calculated on a net basis. For example, you may have bought land for 100k and used the historical cost basis on it. You sell the land for 150k, so you recognize the gain of 50k. All revenues and gains show in the statement of comprehensive income. Next, we have expenses. They would cause a decrease in economic benefit. Therefore, net assets would decrease and equity would decrease, other than from owner distribution. Expenses also include losses. However, dividends are not considered an expense. Expenses are likely to occur. For example, you can have insurance, advertising, rent, wages and salaries, depreciation and supplies expense. Losses, however, may or may not occur. For example, you can have an uninsured fire loss, which means sales would be less than the book value. All expenses and losses show in the statement of comprehensive income. Income and expenses are adjustments made at the end of the period. The time period assumption assumes that accountants divide the economic life of a business into artificial time periods. This is done so that information can be decision useful, and to have these periods of enhancing quality of timeliness. Recording income and expenses. There is the initial assessment if there is a revenue or expense made in accounting events. Next, there is a reassessment that must take place at the end of the period. Adjusting entries are results from the reassessment. The adjustment must provide a relevant representation of assets and liabilities. Assets and liability balance usually need to be reassessed. Some events are not generalized daily because doing so would be inefficient. Such as supplies being used, you can just adjust them at the end of the period. Some events are not reliably known until the end of the accounting period. For example, let's say you have an account receivable and it turns out that you are not expected to collect all of it. For some of it, they are not going to go pay. Therefore, the balance is overstated. This is not a faithful representation to be shown on the larger amount. What if inventory is initially shown at cost? If it is shown at cost value, at the end of the accounting period, is that the minimum amount of future economic benefit? What happens if we don't? What if there's damaged or outdated inventory? Then the inventory would have to be written down and we'd only know at the end of the period how much inventory was left at the end of the period. Some items are not recorded because they are not on an invoice base, and no invoice was received or sent. In a revenue context, most businesses record when they send their invoices. But the past event has no invoice, so there's a provision of service. Expenses can also happen in this way. They record when they receive the invoice, but they can experience the expense and not yet have the invoice but still need to record the expense and liability. Sometimes, businesses follow the cash basis of accounting during the period, thus overstating revenues and/or expenses prior to adjustment. For example, they would credit supplies expense instead of increasing the supplies asset. So at the end, they would reduce their expenses at the end of the period instead of increasing income. Asset or liability overstatement. Assets have been partially used or consumed. Unearned revenue now may be at least partially earned. This would reduce liability, increase net assets, and increase in revenue. Asset or liability understatement. Services or goods provided, yet the customer has not yet paid, is called a revenue accrual. No payment has been made or liability recorded for benefit consumed. This is called an expense accrual. An example of a liability understatement can be that revenue recorded when cash was received, but obligation to customer is not yet satisfied. To illustrate an overstatement, let's look at supplies. For an example, at the beginning of the period, you have $500 worth of supplies on hand. During the period, you buy another $2,000 worth of more supplies. Logically, you'd now have $2,500 worth of supplies on hand. However, only at the end of the period would you be able to find the ending balance. By finding the difference between how much you have on hand with the ending balance, that means how much you've actually sold. On the other hand, you can have an understatement. Let's say you want to buy prepaid insurance for 2 months. And at the start of the period, you do not have any existing prepaid insurance. You buy a prepayment for 2 periods of insurance, and at the end of the period, you used up 1 period's worth of insurance. Therefore, you still have 1 period of insurance remaining. Thus, that means you've only used up half of the prepaid insurance that you've paid for. So you reduce the amount of prepaid by the amount that you've used. In our next lecture, we'll be discussing how to adjust and correct accounts.